Hello everyone, this is Troy Eckard. I'm the chairman of the board of Eckard Enterprises in Allen, Texas. This is part of a sequence of educational videos and presentations that will help you as a potential high net worth accredited investor learn how the oil and gas industry works when it comes to mineral acquisitions, horizontal drilling, and participating in the exploration here domestically in the United States. Today I want to talk to you about future values and where the future opportunity lies in buying mineral rights and working interest opportunities in the United States. I want to walk you through a sequence of drawings. I'm going to explain to you what each one means. And I'm also going to tell you why I'm presenting this to you today. You know, one of the things I have found over the last 10 to 20 years is most investors who are really focused on traditional real estate or other normal investment asset classes have a hard understanding and a hard time comprehending where the value falls within oil and gas. Hopefully by the time I'm done with this, you'll see where the opportunity for growth, cash flow, and value creation exist in owning mineral rights. So let's get started. First off, in the left-hand corner, I have drawn a square box by two, so a rectangle. Each one of these squares that comprises the rectangle is considered to be a 1 square mile, 640 acre tract of land. Today's horizontal wells most likely are being drilled in particular basins around the country in 2 square mile horizontal positions covering almost 1,280 acres. Now our company, Eckard, we like to buy mineral rights. And we like to buy mineral rights knowing and hoping that there's going to be exploration and successful extraction of oil and gas from those mineral rights by some oil and gas operator who has leased them and decides they want to drill. What happened about 10 years ago is the oil companies realized this was the largest land or real estate play in the history of the United States. These oil and gas basins were proven to be not only commercially viable, but it's put the United States as the #1 oil producer in the world. So what we knew is at the point in time when horizontal drilling and frac stimulation successfully discovered the key to unlock these reserves, it was a foot race to see which company could lease minerals, drill a well, and by virtue of developing or drilling that well, they would control in perpetuity all future rights of development. So the first thing they did is said, let's go lease the acreage and let's drill a single well and let's drill in as many square miles or 2 square miles or rectangles as we possibly can. Those are called units, producing units. And let's get the leases secured by exercising and agreeing to commit to what the lease terms call for, which is activation. So in this case, under A, we have a 1,280 acre section, one single horizontal well drilling from north to south, and that well now controls all depths in general, all depths, all rights, all formations in perpetuity, which means this lessee successfully fulfilled their obligation. At some point in time, probably about 8 or 9 years ago, the oil companies realized, wait a minute, based on reservoir engineering, understanding through geophysics, geology, this single well was barely touching the actual boundaries of what kind of reserves were in place. Originally, they thought if they fracked it, the reserves were being extracted from the very extent of the lease line, and the frac stimulation that occurred would allow this one well to pull out most of the commercial oil and gas. After a period of time, they looked at the engineering, they had reservoir engineers evaluate it, and they said, wait a minute, we don't think we're even getting close to the amount of reserves in place. So let's come back and let's drill 2 brand new wells side by side. And what they realized is they weren't getting out very far from each well bore. They said, well, what we figured out is the reserves are in place. We don't need a first well, we need a second and a third well. Then they came back later and they said, wait a minute, even the second and third well are not showing us extraction rates that recover the reserves in place. What if we drilled a 4th and a 5th well? So we go from 1 to 3 to 5. In the beginning, you might have been able to buy this mineral acre for maybe $1,000 to $2,000, or maybe even less, because it was unproven. By the time I get a producing well and 2 more activation, I might be paying $4,000 to $7,000, depending on, and this is per mineral acre, depending on how good the reserves are. Of course, it's against supply and demand, right? By the time I get over here, the value is not just the mineral acres, but it's the cash flow being generated from the 5 wells that are drilled, plus the reserves in the ground that will be extracted over the next 15 to 50 years. So we get over here, maybe this particular cost is now running $10,000 to $15,000 per mineral acre. Now, in Eckard's experience, we've been around since 1985. The one advantage that we continually lean on is that we've been involved in these shale basins since like 1997. when we first started participating in horizontal wells right here in Dallas-Fort Worth in the Barnett Shale. We were in some of the earliest stage horizontal wells being drilled in this shale gas formation underneath the city of Dallas and Fort Worth. And so we've had the opportunity to look at almost a 25-year plus history of what evolves as oil companies lease, drill, develop, and produce in tight shale formations. Now, we had an accelerated, I believe, experience in the fact that we started in 2010, okay, 15 years ago. We became a heavy oil and gas investor in minerals and drilling rights up in the state of North Dakota in what's called the Williston Basin or the Bakken Formation. Many of you have heard of that. Well, we get the advantage of seeing a basin, a geological area up in North Dakota that is probably more mature and more advanced in its development than what we see maybe in the Permian Basin or in the Anadarko Basin in Oklahoma. So because of that, we have a tendency to see what the oil companies will do whenever they begin to really extract and dig down into the actual reserves in place, the number of wells they can drill, and the number of formations they actually believe can be commercially produced drilling horizontally with frac stimulation. So let's take you from C over here to D. So D, we have 1 square mile on top of another. We have 3 sections of land, okay, across. In this particular case, it looks like we have 4 wells going north, 4 wells going south. So we call these producing units. Well, if I take that unit and I drop it in over here, now what do I have is I have the development plan that is taking place. Now, I've tried to use different colors so you can kind of see it with your own eyes, but here's the way it works. If I'm oil company A and I have an existing well, and maybe I own the southern unit as well, I may come back and say, you know what, I'm going to drill 2 offset, 2 brand new wells that are low risk like we saw up here under B, but I'm going to drill them not 2 miles, I'm going to drill them 3 miles. Now, why would I do that? Because the vertical section of each horizontal well may cost me $2 or $3 million. Well, if I can drill further horizontally, I get a greater exposure to the reservoir. So therefore, maybe I don't want to spend an extra $2 or $3 million drilling vertically. I might decide to drill this well and the second blue well 3 miles horizontally. But here's what happens to you and I as mineral owners. If we're in this mineral section and we only have 1 well, well, we're only getting 1 well's worth of income. But when it comes back to reunitizing and doing further infill development, we might see that our acreage here that we own, maybe we own minerals down here, maybe we own minerals over here, maybe we own minerals over here. Because of our portfolio mentality here at Eckard, we try to own minerals in all key Tier 1 mineral sections. So I'm sitting here looking at my bottom unit going, I've got 1 well producing for me. I hope they drill more wells. I got acreage up here in the top unit. They've already drilled 1 well. I sure would like them to drill a second well. But what happens is, because I own the minerals in these different units, it's Tier 1 rock, it's Tier 1 economic development, and the oil company comes back and says, we're paying all the cost. Mr. and Mrs. Mineral Owner, you don't have any risk, any exposure. We want to maximize the extraction and volume of those oil and gas reserves that you own in your mineral rights. So we're going to come in and drill 2 3-mile laterals. Well, the company next door in a different color says, we want to do the same thing, but we're going to go from south to north. So they drill 2 this way. And what you're starting to see is a pattern of how these oil companies are realizing they have multiple different opportunities in which they can drill wells across lease lines, meaning across different sections. They unitize and they get the appropriate permits and they get the necessary permission from the mineral owners. But here we are in this unit thinking all we have is 1 well. Before we're done, we have 1 well to the north, 1 well to the south, 2 long horizontals. And guess what? We're not even counting that most of this is either in 1 or 2 reservoirs. And in some cases, you might have as many as 4. In the Permian Basin, you might have as many as 20 different individual reservoirs that can be drilled horizontally, anywhere from 4 to as many as 20 wells per section. The idea for you is simply this. Mineral rights are real estate. They're held in perpetuity. The oil and gas has been buried in a single geographical space. Whoever owns Tier 1 minerals has the future of infill drilling and density drilling all at somebody else's expense, which creates tremendous value over the next 20 to 100 years. I'm Troy Eckard. I'm the chairman of the board of Eckard Enterprises. Thank you for listening.